You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Thank you, Jim.
A bunch of people are meeting in Davos, Switzerland. They're supposed to be solving the world's economic problems. What kind of a meeting is that, really?
Solving the world's problems. That's actually quite funny. I think making the world's problems has more to do with what's going on in Davos. Every year we see the same parade of the same, so-called experts from the finance side who are just the add debt and stir crowd, which has taken us to the brink of financial disaster. And they just get together and slap each other in the back, have martinis, and talk about how smart they all are. And, of course, they miss the reality of what's gone on in the real world because they live in a sort of a bubble-like condition where they're not dealing with anything in real terms. And it's quite a farce. So, what I found, for example, there was you'll see a bunch of the, quote, elites having these sort of discussions about why they don't believe that the global markets are correct to be correcting here, that, it should be just a minor downturn because there's nothing fundamentally askew in the global economy and, that doesn't make any sense. People are overreacting and all that sort of thing. Of course, none of them were saying that people were overreacting when stock markets were soaring through the roof between 12 and 14 on QE3. At that point, we were saying, geez, things are overshooting to the upside way too much relative to the actual pace of growth and corporate profits and that good stuff. And, we were correct. It was overshooting, which just meant that things were getting more and more overvalued and out of whack and more dangerous, more likely to mean revert to the downside. So here we are coming into 2016, with the S&P only off just over 10%, 12%, something like that. Actually, between here and the sort of support level, Jim, at around 1520, which was the peak of the last two cyclical expansions since 2000 for the S&P, that's a 17% drop from where it is right now, and there's literally no support whatsoever technically in there. And that's because, as I say, it was overshooting on QE mania with no good, organic reason or connection to actual growth in the world. And these policy talking heads were, all taking credit for the overshoot, and now everyone's sort of, distancing themselves from the downturn and saying it's all irrational and unnecessary and that sort of thing. And then, even worse, you get people like the head of BlackRock saying, I don't understand why people are so angry, and why in the political discourse is the Democrats and the Republicans attracting, anger from the voters. Why are they so frustrated? We have to look into what's going on here. Like, no understanding that crowd that siphoned all those trillions of dollars out of taxpayer support in the world in 2008 and have rode the wave of liquidity from central banks over the past 4 years to make themselves billionaires and gazillionaires, no realization that actually extracted value out of the real economy, that actually kept jobs and productivity back, that has actually hurt the portfolios and savings of the people working all over the world. Earnings growth hasn't even been what people expected it to be, and that's even with a whole bunch of financial engineering. So I think there's a real disconnect here, and I say that's why you have revolutions throughout human history, because the elites that get the most preferential treatment and, free money given to them essentially credit that to their own personal acumen and talent and don't realize that they've been given this unfair gift. And so they never want to give any back or acknowledge that it wasn't something that they deserved. So we have this wide gulf between that elite class and everybody else who's looking around going, wait a minute, what just happened here?
Yeah, and don't expect the banks to look after your back. Goldman Sachs fined finally $5.1 billion for its role in the subprime mortgage scandal. However, during the period of the scandal, they made $35 billion. So what's a $5 billion fine?
Absolutely. And, you have people like Jamie Dimon, as an example, the J.P. Morgan head, he's being interviewed at Davos in this embarrassing circle where they're all saying, now what is Jamie Dimon doing with his money? Well, let me tell you, Jamie Dimon made himself a billionaire on QE liquidity in the past 4 years. And he had worked himself up from being fired at Citigroup, 30 years ago, as a sort of a VP, and then worked himself up through the bank. Now, how he made his money was by selling risk to everybody else, by doing, that being the head of an institution that breaks laws on a daily basis and pays fines at the cost of doing business. That's how he got rich. It's not because he has investment acumen, and to look to someone like that for advice on what to do with one's savings is catastrophic. There was another SEC memo I just received today where the SEC said that they've announced that State Street Bank has agreed to pay a $12 million settlement for charges that it conducted a pay-to-play scheme through its senior VP and a hired lobbyist to win contracts for Ohio pension funds. So, the level of criminal activity that goes on a daily basis in the finance sector today is without precedent ever, actually. And there's many initiatives currently underway to help get that genie back in the bottle, so to speak, to get that cartel broken up, as we've had to break up other cartels in history. But it's there's this force of people that see what needs to be done and are moving steadily towards it every day. And then, as I say, this elite class, which has been the benefactor of this unfair advantage, who doesn't see what the problem is and doesn't understand why the rest of us are concerned.
Is it time to revamp the banking system, if the banks let us?
Well, and there's a lot of initiatives, as I was writing today on the blog, Reinventing Finance, the time is now. I go through there, a number of countries have put forward these. So we've talked in the past, Jim, about the Bank of Canada lawsuit, where the Committee on Monetary and Economic Reform has advanced a case, with constitutional lawyer Rocco Galati, who's saying that Bank of Canada should be doing direct infrastructure interest-free lending to federal, provincial, and municipal governments as they were mandated to do and as they always did before 1974. In 1974, the then Pierre Trudeau government made a deal with the devil and entered the Bank of International Settlements, and since then the agreement was that all government lending that for infrastructure, whatever was needed, would go through the private sector banks. And so for the last 30 years or more, 40 years, you've had, them collecting billions of dollars a year in unnecessary interest payments, basically paid by taxpayers, to fund infrastructure spending, which is needed in the country. And the lawsuit is saying this is unconstitutional. It's actually, unfair and unnecessary and a complete, waste and abuse of trust of the taxpayer. So that the lobbyists have continually been trying to throw that lawsuit out as it's made its way through the federal court system in Canada. Now it's heading for trial, and the latest roadblocks have been removed again. The judges keep saying, no, actually, he makes a good point. It's a valid constitutional argument. We need to actually hear it. And the same thing is happening in places like Switzerland, where they've put forth, they've announced they're going to hold a referendum on the proposal to strip the commercial banks of this ability to create money that they've been doing ad nauseum in the past, 5 years, and creating all this great dislocation and malinvestment and treachery in global finance. Canada and Switzerland aren't the only ones either. You've got similar developments in Russia, in Iceland, in Ireland, in Ecuador, all saying, hey, why are we letting this, illegal cohort of runaway criminals take all the public purse funding and make themselves incredibly wealthy at the expense of everything else, as I say, leaving IOUs in the drawers everywhere? Why are we allowing this to happen? They're without, legal principle. They're basically out of control. Anyway, so slowly but surely, and it has been slow, Jim, I'll give you that, we've got serious initiatives being advanced. And I think here's the really great thing that's coming out of this next cyclical decline, which has commenced. We're already into a bear market in many asset prices all over the world. And actually, sorry, I'm kind of excited. You can tell it, Jim. There's been a lot going on that feels cathartic. And it's good in the sense that, I wrote about it in my book years ago. I said that being in financial markets is often like being in a dysfunctional family of drug addicts, where everyone keeps telling you you're the one with the problem, even though you're not the drug addict. And every so often crisis hits, and then everyone says, oh, geez, maybe we do need to go into rehab. Well, we're in one of those periods right now. And the income paying stuff, which is what everyone was herded into as rates were low the past few years. And I was saying, I'm worried because, people that can't afford to lose money and need income and don't want a lot of capital risk are being herded into these higher risk products. And as price went up, higher and higher risk, So in fact, that's exactly what's happened. If you look at it, the things like preferred share index is down 28%. Just from December of 14. The dividend-paying stocks are down about 24%. Canadian financials about 16%. The REITs are off already 18%. So this is where the bulk of the risk is right now in financial markets, is in these dividend-paying things. And as they mean revert and correct, as all the other sectors already have, like the golds and the energies and materials, they've already mean reverted. As these dividend-paying things do, the TSX is coming down smartly with it. So far, the TSX is already off 20% from, April of 15. So it's already officially into a bear market. And this third bear market of this secular bear period that began in 2000 is very likely to test the prior cycle lows, which were 2009 lows. Now, imagine the shakeup that's going to happen this time for a third cyclical decline bear market of that magnitude. And here's the kicker. Central banks completely at zero out of bullets and no room to stimulate, so to speak. So I think this time this is set up for a final cathartic revelation that these people do need to go to rehab, and some of them do need to be put in prison, and we do need to break up the powers that have allowed them to run amok so long.
I didn't look at the figures for the last election campaign, but previously, traditionally in Canada, both the Liberals and Conservatives received the same contribution from the banking industry to fund their campaigns. Did that happen this time?
Oh, I'm sure. They're the most powerful. Them and the oil lobby are the most powerfully, connected and well-funded up until the recent collapse in the energy sector. They had an enormous amount of political pull, both in this country and in every country in the world. And so, that cartel is currently in a shake-up period as well. And, there's a rally today in global markets, but things have been basically relentlessly falling every single day since Christmas Eve, so you have to expect you're going to get interim rally days, short covering, pension funds and people that are mandated to be long the market at all times have to rebalance at some point when things have fallen as much as they have. They look and say, ooh, we're underweight 20% stocks, we're going to have to buy some. But the thing is, they don't have a lot of cash on the sideline at any particular time anyway. And every time that that there's any buying interest, a lot of other people are selling into it with both feet. So I think that the downside is not yet defined. I think that we're probably going to see this thing have legs for a number of months yet, maybe into the fall. Maybe then we'll start to get some attractive entry points. But the VIX still hasn't made it over 30. I think, you're in a state of real panic deleveraging when you get the VIX into the 40 and 50 range. We haven't even seen that yet. And the leverage and the margin calls force their own selling. And we know we were at record leverage coming into this period, again, thanks to QE and uber confidence among the financial elites. So I think, what I think everyone needs to do is stop listening to people talking about, well, China's not falling out to pieces and there's still billion people and they're still going to need things. Like, none of that matters, okay? That's completely separate from the issue here, because financial markets have not traded in line with fundamentals for a number of years because of the over-leverage and financial engineering that was going on. So financial markets became incredibly overvalued, and now they're mean reverting. And trying to draw a connection to the organic strength in the economy and, make a point about why the market shouldn't be overshooting is just as futile here as it was when they were soaring up for no reason, So, it's a cleaning process. It's a cathartic cleaning out of the riffraff and nonsense that's gone on here. that's made everyone look bright. And now as prices plunge, the people everyone thought were genius are being shown to not have an actual value to offer. Some of the most esteemed money managers that everyone thought were genius the past few years are realizing that no, they too were just riding a QE wave up. Even Berkshire Hathaway's down more than 17% so far, because guess what? At his size and, long-term hold kind of approach, Berkshire Hathaway has begun trading with the S&P over the last 15 years. So it falls with the S&P typically. Now it's down worse than the S&P so far in this cycle since it began. But I think you're going to see more correlation with that. Some of the favorite Canadian funds and managers are just getting their heads handed to them right now. And that, again, the Sprots and Gluskin Chefs and Dundees and all those people that were sort of the revered, quote, Canadian fund co's or money managers, in reality, they were just riding this, first of all, the commodities boom up, and then it collapsed, and they all lost their shirt with it. And then the QE was the benefactor that drove flows internationally and unrealistic assumptions for Canadian growth, and Canadian stocks responded, and those same people rode that wave up, and now they're collapsing with it in terms of their prices and share values and all that. So it's a good game played slow, this whole investing thing, at the best of times, but in a secular bear environment where people have been through the greatest credit bubble in human history, central banks have aided and abetted the greatest speculative episode probably ever in human history. We're now in the mean reversion of that. And so, people have to be extremely cautious with their capital here, not be lured into any of these, distractions about whether China's imploding or not, and realize this is strictly about financial assets that became insanely overvalued. And now they're having to correct for that irrational exuberance.
The Chinese government still thinks it can spend its way out of economic trouble, at least on the stock markets, throwing in another $25 billion in quantitative relief.
Right. Well, we've seen round after round after round of this. And again, one of the so-called headlines that boosted the rally this morning was this idea from the ECB's Draghi that he can maybe increase the amount of QE he's been doing. But there is absolutely definitive research and academic reports now pointing out the obvious, which is that QE doesn't work. It gooses asset prices to unreasonable levels, but once animal spirits realize that they're way above, the stratosphere in terms of any realistic valuation, and they start to lose faith in the magic of the great pump, which is this QE idea, then prices mean revert. And as soon as prices mean revert, everyone has to acknowledge that QE doesn't work. It's a complete waste of funds. And that's why there's a lot of people calling to rein in these central banks and not allow them to, quote, just print money and keep inflating financial assets. But lots of academic studies have said, look, not only does QE not help in the economic expansion, an expansion of reserves contracts the economy. Like, there's actual evidence that it contracts growth. So actually what you're doing is completely counterintuitive and countercyclical, and not positive, but negative. And so I think we always knew that would be the case. It's taken about 4 years for people to finally come to that conclusion. But as I say, once these asset prices begin to fall, as they have been doing, and the tide goes out, so to speak, then they have no legs to stand on to justify their theories anymore, and everyone starts getting angry and calling for their heads.
Danielle, thanks a lot for chatting with us.
Thank you.
I hope people are listening. We always have that hope. My guest has been Danielle Park, president of Venable Park Investment Council Incorporated. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.